Apple is arguably the most successful tech giant in history. But what do its actual numbers tell us about its future? We are going to dive deep into Apple's balance sheet to see if the tech giant is still an unstoppable money machine. This bar chart illustrates the trend in Apple's cash and equivalents over a 3-year period from 2023 to 2025. First, this buildup is a direct result of Apple's highly profitable business model. It reflects robust sales across hardware lineups and steady growth in its high-margin services sector, generating massive inflows of operational cash. Second, strategic positioning. In the tech industry, 2025 has been a pivotal year for large-scale investments in artificial intelligence and next-generation infrastructure. By aggressively expanding its cash reserves, Apple has built a substantial war chest to fund massive capital expenditures, R&D, or potential strategic M&As without relying on debt. Lastly, while Apple is famous for returning capital to shareholders through aggressive share buybacks and dividends, this chart implies that their earnings growth in 2025 was so strong that it outpaced their capital return programs, allowing billions in surplus cash to accumulate on the balance sheet. Now, let's pivot to the second crucial component of Apple's liquid assets: short-term investments. Short-term investments typically mature within a year. In 2025, rather than rolling these maturing bonds and securities over into new investments, Apple chose to cash them out. This directly explains why their cash and equivalents jumped by nearly $6 billion in the same year. They prioritized ultra liquidity over interest income. If we do the math, short-term investments decreased by roughly $16.4 billion, while cash only increased by about $6 billion. This means the remaining $10.4 billion was actively deployed. Apple pulled money out of investments to fund heavy operational expenditures. The primary destination for this capital in 2025 was almost certainly massive infrastructure investments. To maintain its competitive edge, Apple needed immediate, frictionless access to billions of dollars to secure AI chips, build out data centers, and accelerate R&D objectives best served by cash rather than locked financial assets. This third chart combines cash and equivalents with short-term investments to show Apple's total liquidity from 2023 to 2025. This chart completes the story of Apple's financial agility. Going from $65 billion down to $54,697 million isn't a sign of weakness. It is a sign of execution. Apple spent over $10 billion of its own banked cash in 2025 to fund its future growth engines, all while maintaining a $54 billion cushion. This ensures that Apple remains one of the most financially resilient and strategically armed companies on the planet. Now, let's shift our attention from liquid assets to an essential operational metric: inventory. This bar chart tracks Apple's inventory value from 2023 to 2025 in millions of US dollars. First and foremost, a shrinking inventory means products are not sitting on shelves collecting dust. Consumer demand for Apple's core hardware lineup was exceptionally strong, meaning products were shipped out to global markets almost as fast as they were manufactured. Finally, this highlights Apple's legendary just-in-time JIT manufacturing strategy. For a company that generates hundreds of billions of dollars in annual revenue, maintaining an inventory footprint of just $5.7 billion is an extraordinary feat. It shows absolute control over suppliers and an optimized logistics network that minimizes warehousing costs and prevents product obsolescence. Moving from the asset side of the balance sheet to the liabilities, let's look at Apple's short-term debt from 2023 to 2025. In 2024, Apple grew its short-term debt by roughly $4 billion. Simultaneously, its short-term investments peaked at over $35 billion. Apple was essentially borrowing cheap short-term money to maintain a massive liquidity cushion and fund immediate corporate needs without touching its core cash. Remember our total liquidity analysis, which showed that Apple net spent $10.4 billion in 2025? We now know where part of that money went. Roughly $2 billion of that liquidated cash was deployed right here to pay down short-term debt and clean up the liability side of the balance sheet. Next, let's examine a very specific and telling line item on Apple's balance sheet: the current portion of long-term debt from 2023 to 2025. In corporate accounting, this represents long-term bonds or loans that were issued years ago but have now matured to the point where they must be repaid within the next 12 months. Why is this number growing every year? To understand this, we have to look at Apple's past activities. During the era of historically low, near zero interest rates, Apple issued massive amounts of cheap, long-term corporate bonds to fund its operations and stock buybacks. What we are seeing in this chart is simply the clock running out on those legacy bonds. They are rolling into the current liabilities window year after year. This chart gives us the ultimate answer to where Apple's 2025 liquidated capital went. Recall our earlier analysis. In 2025, Apple freed up $10.4 billion in net liquidity by cutting down its short-term investments. Faced with $12.35 billion in maturing long-term debt in a high-interest rate environment, Apple made a brilliant move. Rather than issuing new, highly expensive bonds to pay off the old ones, Apple utilized its massive cash inflows and liquidated investment assets to pay off a significant portion of these maturing obligations in cash. This aggressive net debt paydown successfully insulated Apple from rising borrowing costs. To wrap up our analysis of Apple's liabilities, let's look at the big picture: total long-term liabilities from 2023 to 2025. This chart forms a perfect, beautiful contrast with the previous, current portion of long-term debt chart. While the debt coming due within a year increased, this chart reveals that Apple's overall long-term debt burden actually shrunk significantly year over year. When those legacy, low-interest bonds we discussed earlier matured, Apple faced a critical choice in a high-rate environment. They could either refinance by issuing new, expensive debt, or pay them off using cash. This beautiful downward slope proves that Apple chose to pay them off entirely. They systematically wiped out tens of billions in debt rather than taking on higher interest expenses. This chart gives us the second major destination for Apple's 2025 cash reshuffle. Earlier, we deduced that Apple pulled out $10.4 billion in net liquidity from its asset side. We now see that almost all of that liquidated amount matched up with this $11,761 million reduction in long-term liabilities. They literally cleared their books using their banked financial reserves. By aggressively lowering their total debt to under $120 billion, Apple dramatically reduced its annual interest expenses. Every dollar saved on interest payments flows directly back into the company's bottom line, boosting its net profit margins and making the business even more fundamentally efficient. Let's look at the ultimate indicator of Apple's structural changes: total liabilities from 2023 to 2025. In 2025, instead of sitting defensively on idle investments, Apple went on a highly strategic offensive. The playbook was simple yet flawless: high-risk debt, clear out the warehouses, and aggressively expand immediate liquid firepower cash and equivalents up 20%. To bring our entire asset and liability analysis to a triumphant close, let's look at the ultimate indicator of Apple's intrinsic financial strength: book value from 2023 to 2025. As we established in our previous sessions, Apple's total liquid assets dropped by roughly $10.4 billion in 2025. However, Apple didn't just spend that money. They used it alongside massive operational profits to erase a whopping $22.5 billion in total liabilities. Because liabilities shrank twice as fast as assets, the net mathematical result was a massive surge right here in book value. This surge proves that Apple's 2025 net income was incredibly powerful. By running an ultra-lean supply chain evidenced by that 21.5% drop in inventory and turning products into immediate sales, Apple retained immense profits. Instead of locking capital away, they funneled it into permanent financial strength. Now, let's look at a chart that might shock you at first glance: retained earnings from 2023 to 2025. Retained earnings track the cumulative net income a company keeps after paying out dividends and buying back stock. Seeing deep negative columns for a financial powerhouse like Apple can be alarming. However, in modern corporate finance, This chart doesn't represent a loss, it represents one of the most aggressive and confident shareholder reward programs in history. A negative retained earnings balance means Apple has historically returned more money to its shareholders via dividends and share buybacks than it has kept on its books. Instead of letting cash sit idle, Apple buys back its own shares and retires them, which reduces total equity but exponentially boosts earnings per share EPS, driving massive value for remaining investors. The dramatic drop to -$19 billion in 2024 perfectly matches our book value chart from earlier, which showed a dip in 2024. Apple chose to optimize its capital structure that year by aggressively paying out rewards, shrinking its internal equity base on purpose. The most critical insight is the recovery in 2025. Even though Apple continued its multi-billion-dollar buyback and dividend programs throughout 2025, the retained earnings deficit actually shrank by nearly $5 billion. This proves that Apple's net income in 2025 was so massive, it completely overwhelmed their gigantic shareholder payouts, leaving a multi-billion-dollar surplus to fill the equity deficit. To bring our comprehensive balance sheet analysis to its absolute destination, let's look at this final leverage metric, the total liabilities to book value ratio from 2023 to 2025. In 2025, Apple engineered a double win. First, Apple aggressively paid down its short-term debt and maturing long-term obligations, slashing its total liabilities by a massive $22.5 billion. Second, backed by an optimized, hyper-lean supply chain where inventory was cut by 21.5% and record-breaking net income, Apple expanded its core net worth, driving book value up by a staggering 29.5%. For a traditional manufacturing company, a debt-to-equity ratio of 3.87x might seem elevated. But for a global cash cow like Apple, this is a position of supreme financial power. Apple chooses not to hoard lazy equity. Instead, they deliberately keep equity lean to maximize returns on equity row and fuel stock performance. Dropping to 3.87x proves that Apple has achieved the ultimate sweet spot: maximum capital efficiency combined with rock-solid balance sheet security. The story of Apple over these past 3 years is a masterclass in macroeconomic agility. When market conditions tightened and interest rates climbed, Apple didn't break a sweat. They cleared out their warehouses, unlocked trapped capital, maintained a massive $36 billion cash reserve, wiped out $22.5 billion in total debt, and fundamentally upgraded their core net worth. Apple exits 2025 leaner, safer, and fiercely capitalized, fully prepared to fund the future of technology and deliver unparalleled value to its investors.